And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Three of the best in the business, as always, with us again today. Armando Senra, head of BlackRock's iShares Americas. Kevin O'Leary, chairman of O'Shares ETFs and Shark Tank's co-host. And Jim Lowell, CIO of Advisor Investments and Fidelity Investments, editor-in-chief. Armando, let me start with you. iShares is the largest ETF family in the world. You're the guy in charge. Give us a quick overview of ETF trends this year overall. We're still seeing inflows, but it's a little bit lumpy. What's going on?
Yeah, sure, Bob, and great to be here. Let's just begin. It's been a roller coaster of a year for all of us in our lives, and it's no different for the ETF industry, but overall it continues in a strong path for growth. So you have seen a strong adoption of fixed income ETFs. That's a theme that we've been talking about for quite a long time. You've seen strong growth in sustainable, and that's something that year to date that represents 20% of our flows. And you and I would talk about it at the beginning of the year. So very strong growth. We've seen investors becoming more aware and concerned about inflation, and you've seen flows into commodity ETFs. You've also seen, especially during the summer, flows into tips, again, because of inflation concerns. And the other thing that has been interesting at the beginning of the year, you saw quite a bit of outflows from anything international equities related. And you're beginning to see now, with a weaker dollar and also the underweight positions that most investors have to international, you're beginning to see flows back into international. So I would say those are the main themes: fixed income ETFs, the growth of sustainable investing, and what you've seen this year in terms of risk on and risk off and how investors have played that out.
Yeah. Kevin, you've had a good year. Speaking of flows here, we were talking earlier about your Internet Giants ETF, OGIG. You're hitting on all the right notes here. It's 70% gain, I think, so far this year. Notable inflows, I think 300% increase in the shares outstanding there. I guess the question is, you're hitting on all the right stuff. You own the big mega caps in the U.S. You own the two big China mega caps, Tencent and Alibaba there. How much longer do you think we can still have interest in these broad mega cap names before something else like value starts outperforming?
Yeah, I think value just leads you into some pretty dangerous territory, like food services and lodging, hotels, cruise ships. I don't consider those value. I think they're dangerous. What's happening with OGIG is basically the world is changing. It's doing a digital pivot. It doesn't matter if you're doing it here in the U.S. with the FANGs, which are included in OGIG, but it's also happening in Asia. It's happening in Europe. It's happening in South America. And the trend is that people have decided, and of course it's COVID related, but for the first time a whole new generation of people are going online and buying goods and services direct from the various businesses they get it from. You saw it in Nike numbers, for example. But what OGIG tries to do is find the 70 or 80 companies around the world that are the giants that are leading this trend. And I don't think we're even in the third inning yet, because the pandemic is just one attribute, but it's not about staying at home and working. It's working from anywhere and buying anything from anywhere, delivered anytime. And so that is really the engine of what has made OGIG so successful. And I think we're just at the beginning, Bob.
Yeah. And you were one of the guys, Kevin, that was into factors very, very early. You were talking about high quality, low volatility as a factor. And OUSA, I think this is the 5th anniversary for it, was a dividend, but essentially went into the factor area. And factoring has proven to be very successful. There's some academic evidence that factors tend to outperform, but when applied to specific areas, they can also do a little bit better. So OUSA is what, 5 years old now, Kevin? This is a dividend.
Yes.
ETF.
In fact, I remember you were there when we rang the bell on it from the balcony. I'm very excited. It's a big deal for an ETF to get to its 5th year, because that track record really matters in terms of people looking at performance. And it's a dividend strategy, but a quality dividend strategy. And factor really matters. The quality of the balance sheet, the return on assets, sustainability of the business model, the free cash flow, how much debt does the company have? So if you looked at the S&P 500, there's many sectors and many companies I wouldn't want to own. For example, some of the energy stocks, which have 8, 9, 10% dividends, You'd think they'd be great and they would show up all over the place in dividend growth stories, but they are not safe. And I don't think those dividends are safe, and they are certainly not in USA. We've made sure that it's just quality. So it's a subset of the S&P 500, about 100 stocks that we feel are safe to own during these really volatile times.
Right. That's an important thing. It's not a high dividend fund that you're running. It's a dividend fund with quality overlay on it. And that's where you get the distinction with, for example, leaving out the energy stocks.